BRX Text Talk 1400 hours. Thank you for tuning in to Eswatini TV. In this very hour, you are welcome. And today on the program, we want to focus on the country's gross official reserves that have improved to 10.2 billion in the month of April. And that has pushed import cover slightly up to 2.3 months. However, this remains below the generally recommended benchmark of at least 3 months of import cover. More of these figures are contained in the Central Bank of Eswatini's monthly statistical release, and we'll speak to our economist, Sanales Bia, who is going to help us understand them better and what implications they have on your pockets as well as your household and, of course, the economy at large of the Kingdom of Eswatini. Right now, let's look at our business news as we start our program. Our first story, total market capitalization remains steady at 6,932 billion emalangeni between March and April 2026, with no share price movements recorded during the month under review. That is compared to April 2025, where the market registered a 1.12% increase in value. This is according to the Eswatini Stock Exchange April 2026 month-end report that shows stable equity market performance, rising bond activity, and strong year-on-year growth in government securities.
While share prices remained largely unchanged throughout April, the Eswatini Stock Exchange maintained a total market capitalization of 6.932 billion emalangeni, indicating continued investor confidence in listed companies. The exchange currently has 10 domestically listed companies on its main board, with no foreign listings recorded. The First National Bank Eswatini retains its position as the largest company on the exchange, with a market share of 28.45%, followed by Royal Eswatini Sugar Corporation at 23.63%, while SBC Limited holds 14.27% of total market capitalization. Despite the stable market conditions, some companies delivered notable share price movements over the past year. The ESE All-Share Index also remained unchanged at 493.16 points during April, representing a 0.96% year-on-year improvement from 488.49 points recorded in April last year. Trading activity also picked up during the month of April, with equity turnover increasing to more than 160,000 malangeni from just over 23,000 malangeni in March. A total of 78,516 shares were traded, with Inala Capital and Greystone Partners accounting for most of the value traded. The ESE notes that the strongest growth was recorded in the bond market. Corporate bonds grew to more than 2.1 billion malangeni, following the listing of 3 new Select Limited bonds that commenced trading during April, with a combined value of over 91.9 million malangeni. In addition, the value of newly commenced bonds exceeded the value of maturing bonds, contributing to the overall increase in corporate debt securities. Government bonds also expanded sharply, rising 20.2% year-on-year to reach 7.956 billion malangeni after 4 new government securities entered the market in April, worth a total of 283.28 million malangeni. The new bonds carried coupon rates ranging from 10 to 11%. The exchange says it continues to engage stakeholders to attract more local and foreign listings, while also promoting financial inclusion and economic empowerment through public participation in share ownership. Reporting, Nasilas Tole, Vumgosinzinisa, Babane.
Conflict in the Gulf region has crippled into the overall cost of living and that of producing food in Eswatini. The World Bank has warned that as tensions in the Middle East continue to disrupt energy and shipping markets, fertilizer prices may increase by 31%. Urea, a key nitrogen-based fertilizer that is used by farmers could surge by as much as 60%. As local farmers rely heavily on imported fuel and fertilizer, much of it sourced through South Africa, the shock could drive up production costs ahead of preparations for the new plowing season.
Local farmers are bracing for a more expensive planting season as tensions in the Middle East threaten to push up the cost of key agricultural inputs. The conflict involving Iran has sent shockwaves through international energy and fertilizer markets, raising concerns that farmers in Eswatini could face sharply higher costs for diesel, fertilizer and agrochemicals ahead of the 2026-2027 plowing season. Chief Executive Officer of the Eswatini National Agricultural Union, Temid Lamini, says as input costs rise, farmers may be forced to reduce the area they plant, apply less fertilizer, or delay crucial field operations.
We might have a record increase. We haven't seen the new prices landed, but still, because we monitor fertilizer from the global market. Fertilizers such as urea or urea-based fertilizers had increased by about 45%. Ammonia-based fertilizers had increased about 43%. That is not taking into account the transportation costs inland, but we were just speaking about that landed at port. We anticipate that we might face a fertilizer shortage if the base of fertilizer is still stuck and not able to move around. Then we might have a problem. We want to believe that the government is already anticipating that they'll need to have an intervention. For us as farmers, we always think when these disasters strike, it's good to distribute food, but it's even better to try and stop the erosion of our base.
Agriculture is one of the country's most important export earners, with products such as sugar and forestry contributing significantly to foreign exchange earnings and government revenue. If yields decline, the country could see lower export volumes and heightened pressure on food prices. With the next plowing season fast approaching, we asked the Ministry of Agriculture whether farmers will have the financial capacity to absorb these cost increases without compromising production.
But ezisonzela lesikhathi kubonakala ukuthi labo manyolo bayenyuka ngeprice yabo, they will cut down on the areas labawalimako and they will then export less. Impact yaloko ke ngiloko ukuthi labantu lebe ba employed kokucala nje vele ngeke basakhona ukuthi basebente. Ngilokunye ngilokuthi le market lebe sinayo, imarket ifuna iconsistency. Ungaze wehlise lama quantities, but awukwathi ukuthi even the following year lama quantities loto provider wena atawuba ngulawa lese ehlisiwe. Sekufuna uyocala phansi unegotiate kabusha imarket yokuthi sengifuna producer even more nyalo. So vele it's a complication lebuhlungu kutawa affect ema markets ethu.
The International Monetary Fund, AFDB, and World Bank have cautioned that higher commodity prices could slow economic growth, fuel inflation, and place additional strain on countries that rely on imported agricultural inputs. And as for the kingdom, with much need for food security and reliance on export earnings, the stakes could not be higher. Reporting, Nautilus Tole, Vumgosinzinisa, Mbabane.
That's the end of our business news. We talked to Saneless B, our economist, after the break. According to, we look at the Central Bank of Eswatini statistical release.
Agora that are in pain must forget all the problems they have. Because the things of the earth have got no answer. But the answer that we have is all morning. When I'm preaching here, I'm preaching to myself. I receive the Holy Spirit.
I declare that a turnaround is coming my way.
Turnaround is coming in my life.
Welcome back. Our discussion now, the country's gross official reserves improving to 10.2 billion emalangeni in April is our talking point, and that has pushed import cover slightly up to 2.3 months. And however, this remains below the recommended benchmark of at least 3 months of import cover. And a lot of these figures are contained in this Central Bank of Eswatini's monthly statistical release that we discuss now with our economist, Stanley Sbiya, who joins us virtually. And we always appreciate your insights, Mr. Sbiya. Thank you so much for joining us. Perhaps the first question could be around the gross official reserves improving to 10.2 billion emalangeni in the month of April. They also highlight import cover moving from 2.2 to 2.3 months. Just how significant is this improvement, and should Eswatini feel encouraged by these numbers at all?
Thank you, Mr. Ngumalo, and a good afternoon to you and also to the viewers. So when we are looking at the gross official reserves numbers, I mean, that's a slight, we're seeing that there's a slight, decline there, and, just coming back to that 2.3% cover level of import cover. And, like you're saying, it's up from 2.2%. And this just basically signals that the country has improved in its external position, that is in the trade position. But overall, what we are stating, Mr. Ngumalo, is yes, there is a couple of good points coming from this. The fact that we are seeing a nudge upwards in the reserves does show that the economy of the kingdom really is showing some resilience, some resilience in terms of the import cover, but it still remains below the 3-month import cover, Mr. Ngumalo, which is a recommended standard. And now this has a couple of implications for the Kingdom of Eswatini. The first being we have we have increased the vulnerability to external shocks because we can only cover 2.3 months in terms of our imports, and we do know that Eswatini imports over 60% of the commodities that are produced within the kingdom, of the commodities that are consumed within the kingdom, rather. And then also, what it also means, Ngumalo, is that we are at a stage where we are somehow below what is required for the CMA to maintain that peg between the rand and the lilangeni. So those are the issues that we have to contend with as a country. And it also shows that for our gross official reserves, the country is still highly and largely dependent on SACCO revenues, because when you look at the number, this nudge upwards is largely due to an inflow of SACCO revenues, and then that still does show a bit of external vulnerability, though right now, increasing from 2.2 the previous month to 2.3 in the current month does show that we do have an increased external balance and external position. However, the risks still remain, those structural risks still remain in the economy, and the over reliance on SACCO is still quite visible on the economy. But we do need to take caution on the fact that our external position has improved as a country, and we do hope that with proper monetary policy, we are going to get back to that 3% level.
Yeah, I think even with this improvement, Eswatini still remains below the generally recommended benchmark of at least 3 months of import cover. Why is that benchmark so important for our economy?
It's quite important, Malo, because we do know that Eswatini is a net importer. And when you are buying commodities from outside the country, you do need those reserves to actually ensure that you are able to purchase those. That is why they're actually expressed in terms of months of import cover, because it is the reserves that we have that we can use to fund and release liquidity to ensure that trade continues to run smoothly. And then now that shows that we do need to increase those buffers so that we can get back to that 3% of import cover. And then most importantly for the Kingdom of Eswatini, maintaining the peg between South Africa and Eswatini, ensuring that the Rand and Lilangeni are trading at a 1-to-1 position requires that you have those strong external reserves, because the way it works, Numalo, is the government needs to always be in a position to release however amount and whatever amount of rents that are required in the market, because the exchange rate between the Rand and Lilangeni, it does not float. It cannot be allowed to fluctuate. So when there's an excess demand for the rands, government needs to have a reserve from which it can just go and get those rents. And then also when there is that diminishing demand, government needs to also be in a position to ensure that they can take up all of those rents and put them in as reserves. So it's quite critical for Eswatini, more especially to maintain the peg and to also ensure that we are able to cover the rate of imports that we need. So we cannot then as a kingdom take this figure lightly. It's one of the most important matrix that we monitor when it comes to the financial position of the kingdom, and more especially as the central bank continues to do this synchronized monetary policy between South Africa and Eswatini. So those import cover is quite critical. It's one of the reasons why you find that our interest rates with those of South Africa are always equivalent, or if there is a bit of divergence, it's usually a small percentage point divergence. You can't have a huge divergence, because now that would cause capital flight inwards or outwards, and that would have an impact on those reserves, Norman.
The report attributes the rise in reserves largely to SACU inflows received in the month of April. And I know I've asked you this before, just how it exposes how dependent Eswatini remains on SACU revenues for our economic stability. Should we be scared? What is our stance when the attribution is on SACU receipts, on SACU inflows, rather?
So looking at the period we are in, Mr. Ngumalo, where we are dealing with a lot of external shocks, that being part of the fuel shocks that are being caused by the war in the Middle East. And then we also have the tariffs that wreaked havoc into the economy. So this over-reliance on SACU, when the risks are elevated in the economy, it adds on to the risks that the country has to now deal with, and most of these cannot be controlled by the fiscals of the country, by fiscal policy, nor can they be controlled by the monetary policy decisions that are done in the Kingdom of Eswatini. So it does increase the vulnerability that we face as a country. Hence, we've always agitated for a change in the strategy and make sure that Eswatini moves towards more of an export-oriented industry so that you can reduce the reliance on SACU. It'd be more interesting and it'd be more safer if we saw a nudge upwards in the gross official reserves being driven by the levels of exports in the country, so that you are gaining in more foreign exchange. But for SACU to have such an impact and, to have that 0.1 percentage point impact on our gross official reserves standing now does show that we do remain a bit, vulnerable. So we do expect, the central bank to move towards, getting reserves in other forms. There would be, like what the central banks are doing across the world, which has actually nudged the price of gold pretty much up. And now that shows that, the risks that are quite prevalent in the markets require that you diversify your reserve position through the purchasing of precious minerals, which would include gold amongst others, so that you have something that you can liquidate in the event you are running out of those reserves. So yes, you are pointing out to a very important vulnerability. And now when you have quite a number of risk factors that you have to contend with, you kind of need to have a bit of control and make sure that there are dynamics and dimensions that you can control within the local economy. So right now, the level of SACCO receipts are not only showing the impact on the monetary policy, but also there is an impact on fiscal policy, Mr. Nxumalo, because if you look at the statistics again on the net claims against government, it shows that they've actually gone down. But the factor they're influencing that is the fact that government now has received these SACCO revenues, and therefore government is not relying that much on borrowing in this current period. But the vulnerability does remain, and we remain exposed on both fronts, be it monetary policy and be it fiscal policy. So we do need as a country to chart a way out and reduce the level of impact and the level of reliance on SACCO revenues, which at this point would love it if SACCO revenues would come below 30% of the national budget, because if you have 30% of your national budget being funded by how well your trade is doing, then that means you remain vulnerable. And then also we know that the SACCO revenue sharing formula has changed multiple times, and that has left the country vulnerable, because most of the cases when you have these changes, they are never in terms of an upward direction, but they are largely a downward direction in terms of when we are seeing that change. And now that leaves us more vulnerable. So we do need to make sure that we nudge up and we continue ramping up domestic resource mobilization and improving our reserve position by ensuring that we are diversifying those reserves by going into the precious metals, and also you can improve the level of investments outside the country through the central bank, so that we remain less vulnerable, and then such that SACCO receipts will not have this market impact in terms of our reserve position.
Yeah, from weighing in on numbers coming out from the central bank to the Eswatini streets, to now numbers coming from Wall Street after the break, still with our economist Sanele Sibiya, who's not going anywhere after the break.
To all the viewers of Eswatini TV in the kingdom and beyond. Eswatini TV is regulated by the Eswatini Communications Commission through the Broadcasting Code and Broadcasting Guidelines. Under these instruments, the station commits to broadcasting information and news that have been fact-checked, programs and content in respectful language with no elements of hate speech, violence or sexual activity. If you hear any unsuitable content on this channel, you have a right to voice your complaints with the station management. Should you not be satisfied with the response or action taken, you can escalate your matter to the Communications Commission at PO Box 7811 Babani. Call 2406 7000 or send an email to info@esccom.org.za. For more information, visit www.esccom.org.za.
Thank you for staying with us. Our market analyst is now with Sanele Sibiya, who joins us again virtually. Sanele, thank you for staying with us. You may take the floor now and take us through the numbers coming out of Wall Street.
I thank you once again, Mr. Nxumalo. So when we're looking at what is happening in Wall Street, we are seeing, a bit of divergence in the numbers with the Dow Jones Industrial Average taking a knock and the Nasdaq Composite taking a hike there, and the S&P 500 hitting at another record. So what we're seeing happening in the markets is, just before Cisco actually announced their earnings numbers, the Dow Jones Industrial Average somehow pulled back some 67.36 points. But when Cisco announced those numbers and the fact that they made profit, we are expectant that when markets open on opening bells, we do expect the Dow Jones Industrial Average to hit that 50,000 mark in terms of overall share volumes, and then in terms of the Nasdaq Composite Index, it's back on that 26,000 mark. Which is slightly getting back to those pre-war levels, again driven by the performance of those top tech stocks, which amongst others include Cisco. And also we are cognizant of the fact that there is a bit of ease on the markets and expectations of what the outcome is going to be in terms of the US-Iran-Israel war, because we've seen the conference between President Trump and President Xi. And one thing that these two leaders agree upon, Mr. Nxumalo, is the fact that the Strait of Hormuz must remain open regardless of what the direction of the war. And now what this sends to markets is a bit of ease, because we know that there is a very good relationship between Tehran and Beijing. So we do expect that we should see a bit of some traction there on that front. The Standard & Poor's Index is up 43 points. Very close to records that we saw before the pre-war level. So what we're seeing happening in the US, Nxumalo, is the fact that the markets are just basically focusing on the earnings on today rather than focusing on the geopolitical tensions. But the geopolitical tensions do remain a very critical risk factor, and we're hoping that that those talks between President Xi and President Trump are going to produce somewhat of a positive outcome for the markets. Moving on to the European markets, we can see that the London is up slightly 29%, 29 points. The DAX in Frankfurt is up 288 points. And the CAC 40 is actually up 46 points in today's trade. So when you're looking at these numbers, Nxumalo, they do show some signs of an upward nudge. However, if you are tracking it on a 2-week or a 3-week average, or even on an 8-week average, on a 10-week average, in terms of when the war started, we are seeing that overall we have a downward decline across all these three indices. And these slight changes that we are seeing today are largely a flat line. So this just shows how vulnerable the European markets are in terms of those movements, in terms of the price of Brent crude oil, and which today is sitting at $106, dollars per barrel. And that just shows that the war is having those market impacts on the energy markets. And, Europe imported quite a lot of that, of energy from the Persian Gulf countries there, and the Strait of Hormuz remains very critical, and the infrastructure remains very critical in terms of keeping Europe very much steady there. And we've also seen the growth numbers coming out of Europe taking a tumble by a 0.1 percentage point there, and all of those are factors that are affecting this flatlining that we are seeing in markets. Coming into Asian markets, the Nikkei is down 618%, and the Shanghai Composite Index is down 64 points, with, the tech-heavy Hang Seng, just taking a bit of a lift from U.S. markets, just up marginally 0.6 points in today's trade. Now, what we're seeing here is in Japan, it's more of a market correction following the rally, because that at some point markets do need to stabilize. And then in Shanghai, there we're seeing that inflation fears are creeping in strongly into the markets, and markets expected more of a firm outcome to come out of those talks between President Xi and President Trump. But right now, what we have is more of an agreement that the Strait of Hormuz must remain open without any congruent action points there. And the Johannesburg Stock Exchange is up 928 points to sit on 118,000 in terms of overall share volumes in today's trade, driven by performance of the industrials and the financials, and a bit of easing of those jitteriness, because the way that the South Africans are interpreting the outcome of the talks between President Xi and President Trump is somewhat of a positive stance. And then coming into the commodities, gold is down 7.7 points in today's trade to sit on $4,699 per ounce there. Now that shows that though we still have elevated inflation risks, there is still that shift towards interest-bearing assets, because we expect the interest rates to go up. Brent crude, because of the elevated tensions, stays above the $105 mark there. And then when we come into the currencies, we're seeing relative weakness of the lilangeni against the dollar, trading at 16.42, and also weakness against the euro, trading at 19.22, and more weakness against the Japanese yen, declining to 9.63 Japanese yen, driven by the fact that we are not seeing any concrete evidence coming out of the talks between President Trump and President Xi. Thank you, Mr. Nxumalo.
Thank you, Mr. Spear. That marks the end of our program today. Enjoy the rest of your day. Goodbye.